A US software company closes the quarter with record volume and a lower unit cost. Revenue is up. Average operating cost is down. Yet the company still misses its operating margin target. Scale did not fail. It changed what profit now depends on. An AI-enabled service can spread infrastructure, integration, and oversight across more customers. That improves unit economics, but it also increases the commitments beneath each quarter's result. Capacity is reserved. Support teams become permanent. Customer contracts remain fixed, while service costs continue to move. Scale can make the business more efficient, while making profit more sensitive. That matters in US markets, where management is judged against quarterly guidance and margin expectations. A system may be sound over several years and still produce unstable profit between quarters. As the platform grows, missed utilization becomes more expensive. Consider a simple modeled example. One business supports 10,000 monthly transactions with a flexible structure. A second supports 100,000 after adding dedicated infrastructure, integration staff, and service commitments. The larger business has a lower cost per transaction, but if volume falls, the smaller business can reduce more spending. The larger one carries a heavier cost base into the weaker period. Scale improved efficiency. It also increased exposure to underutilization. The decisive difference is not volume itself. It is the gap between committed capacity and realized demand. At small scale, many AI costs still appear variable. Usage can be limited, pilots paused, and external capacity reduced. As adoption expands, firms reserve infrastructure, sign broader agreements, and support more departments. Costs that moved with activity begin behaving like fixed obligations. Flexibility at small scale often becomes commitment at large scale. When demand rises above that base, additional revenue creates operating leverage. The platform already exists. Support functions are staffed. More customer activity can therefore produce faster profit growth than revenue growth. But the result holds only inside a defined operating corridor. If volume weakens while capacity remains unchanged, cost per transaction rises. If customers use more compute-intensive features without paying more, contribution margin falls. If service expectations require human review or continuous availability, operating burden may rise before revenue does. Stability depends on what must remain available when customers do not use it. The problem sharpens when revenue and cost move on different clocks. An enterprise customer may sign a multi-year agreement with stable pricing. The provider pays for cloud consumption, model access, storage, and monitoring as usage changes in real time. Revenue per account remains fixed, while service cost moves daily. The gain is real, but only if usage growth produces more monetized value than infrastructure, review, and support burden consume. Early margin evidence can therefore mislead. A pilot may use shared infrastructure, limited support, and a narrow user group. At enterprise scale, the system must absorb irregular demand, legacy integration, exception handling, service commitments, and continuity requirements. The model call may remain inexpensive while profit becomes less predictable. Surface economics can improve while the operating foundation becomes less flexible. Quarterly pressure intensifies the mismatch. Management may approve capacity for expected growth because delay could constrain service quality. The cost appears immediately. Revenue may arrive later or below forecast. Margins compress even though the long-run cost curve still appears attractive. The question is whether revenue, utilization, and committed capacity mature on the same schedule. Competitive pricing adds another source of instability. When firms achieve similar efficiencies, cost reductions are rarely retained in full. Some pass to customers through lower prices, richer features, or higher usage allowances. Scale may preserve competitiveness without widening margin. A small pricing concession across a large revenue base can outweigh a meaningful reduction in unit cost. The two effects now converge. Scale lowers the visible cost of each transaction while enlarging the fixed platform beneath it. It also increases the profit impact of small changes in price, demand, and usage mix. The system becomes more efficient and more sensitive at the same time. Stability improves only when recurring demand, capacity discipline, and pricing durability reinforce one another. Organizations miss this when they measure averages, inference cost, labor minutes, gross margin, or revenue per user. These describe expected conditions, not what happens when volume weakens, expensive features dominate usage, or capacity cannot be reduced. A stable profit model is not simply one with the lowest average cost. It remains acceptable when conditions move away from forecast. Three forces operate together inside the same system. Scale efficiency spreads fixed cost across monetized activity. Operating leverage makes profit move faster than revenue once the base is established. Structural fragility appears when cost cannot contract as quickly as demand or price. The practical test is to hold infrastructure, staffing, and service commitments constant while reducing demand, lowering realized price, or increasing high-cost usage. Finance teams can then observe how quickly margin deteriorates, how much cost remains locked in, and how long the business can operate outside its preferred range. The earlier example makes the distinction clear. The larger business has superior average economics. Its profit is more stable only if demand remains recurring. Capacity can be adjusted within a reasonable period, and customers continue paying for the value created. Without those conditions, the smaller operation may look less efficient while remaining easier to defend. Scale stabilizes profit when it spreads durable cost across recurring demand and preserves pricing. It destabilizes profit when it converts optional spending into commitments, builds capacity ahead of uncertain revenue, or exposes a large revenue base to small pricing changes. Scale reduces the cost of normal operation. Profit stability depends on the cost of operating outside normal conditions.